So here we assumed that the annual cost savings would start in 2010, right? It's 625 million, but we have to deduct taxes, so you end up with an after-tax cash flow of 406 million, okay? And as we did in the lecture notes, we are going to assume that these cost savings are going to continue into the future. If you think about it, that is a reasonable assumption, right? If a company cuts costs, this cut in cost is going to affect profits both today and in the future, okay? The growth rate that we are assuming here is a growth rate of 2%. So the cash flow is going to grow from 406 to 414 in 2011, and then we have the dots, meaning that this is going to go on into the future, right? And as with other valuations we did in this course, right? When we see the dots, we are thinking of growing perpetuity formula, right? We have to apply the perpetuity formula to the cash flow. So we have 406, right, discounted by 8% minus 2%, which is the growth rate, okay? And remember, every time you apply the growing perpetuity formula, you're going to bring the value one period before, okay? So this value here is going to come to year 2009, right? So that's why here in the formula you have the growing perpetuity minus the integration cost as the net present value of the synergy, okay? So that is the calculation that you would need to do. And here what you see is that the NPV of the synergy in this deal is estimated to be $5.6 billion, okay? Now, let's recall a very important principle we learned in the lecture notes, okay? For the acquisition to be positive NPV for the acquirer, right, the synergy has to be greater than the premium paid to the target, right? So now let's figure out the premium, right? So here you have the price that Kraft paid for Cadbury, right, minus the price of Cadbury prior to the deal announcement. Actually, this is the offer value, right? It may not be the price that Kraft actually ended up paying. We're going to talk about that in a second, okay? But just looking at that data, the premium that Kraft offered was 30.5%. If we express that in dollars, right, given that Cadbury was worth $12.8 billion prior to the deal, we would get a premium of about $4 billion, or 3.9. Okay? So in this case, since 5.6 is bigger than 3.9, right, as long as the management is right, that means Kraft is generating a net present value of $1.7 billion from the acquisition of Cadbury. Okay? Now let's go back to module 3, right? Since the NPV is positive, what should have happened to the stock price? Kraft's stock price should have gone up, okay? But that, of course, is only going to happen if the market agrees with the management, okay? The market, of course, has to be doing the same calculation that the management is doing, okay? But if you read this mini case, in fact, what happened is that the stock price decreased, right, from 28.1 to $26.4. Okay, a decrease of 6% when the merger was announced. So Kraft, rather than gaining about $2 billion, Kraft ended up losing $2.4 billion of value. Okay, so the market view of the merger did not agree with the management's view, which is a very common situation, right? The market in this case thinks that the synergy that is associated with the deal is lower than the premium that Kraft is paying, right? The management thinks that the synergy is bigger than the premium, so the deal is positive NPV, but the market disagrees, okay? The synergy is not that large. The synergy ends up being lower than the premium, therefore the market decreases Kraft's stock price, okay? So really, it's a very simple analysis, and it's all based on premium and synergies. And this reflects a common problem that we talked about in Module 4, right? Acquirers tend to pay too much to targets, right? What we learned when we went over the notes in Module 4 is that targets tend to gain, a significant increase in their stock prices when a new deal is announced, but acquirers on average don't gain anything. There are many M&A deals in which the acquirer's stock price goes down. Kraft is another example of that, okay? In fact, an interesting thing we're going to talk about now is that the market reaction actually suggests that the market expects Kraft to pay even more, right? Because the stock price of Cadbury actually went up to 7.91 pounds when the deal was announced, which is higher than the value of the offer, right? So the only reason for that has to be that the market expects Cadbury to get more than 7.45, right? So at some point, right, Cadbury's stock price has to go up, to more than 7.91. Otherwise, the market reaction would be irrational. Okay? What happened in this case? It's very interesting that, in fact, the market seemed to have been correct. Okay? On September 12 of 2009, Cadbury rejected the offer. Okay? And then what happened after that is that Kraft tried to make the offer work. So first in November, they announced a formal tender offer to the shareholders of Cadbury. This initial offer was on the same terms of the initial friendly bid, but that was immediately rejected. Cadbury was obviously trying to get a better price, and in the end, in January 20th, 2010, the companies ended up agreeing to a deal, but the offer was sweetened. It was a much sweeter offer for the shareholders of Cadbury. Kraft ended up paying a premium of 48% instead of 30%. Okay? So the market was probably correct to estimate that Cadbury was going to end up receiving a higher offer down the line. Okay? So that was question 1. Let's move on to question 2, which is part of the questions where for which the goal is to allow you to discuss the course concepts in your own words. Okay? So this question is about cash and mergers, right? What we learned in this module is that cash-rich companies do tend to acquire more, right? They become more acquisitive, they make more acquisitions, but these acquisitions are now not necessarily good for shareholders, okay? So remember this idea, having cash to spend, right, is a wrong reason to engage in an M&A deal, okay? Managers would avoid many mistakes if they remember this simple idea, okay? That's what I wanted you to discuss in this question. Question 3 was about leverage buyouts, right? It's a situation where a company is being targeted by a private equity fund, okay? Remember, what we learned in class is that in order for private equity funds to generate value, they have to restructure, right? There is no usual synergies, right? Because private equity funds are managed by an investment company, so it's not the case that there are horizontal synergies or synergies from vertical integration, right? So private equity funds have to rely on restructuring, cost cutting, right? Or perhaps to buy companies that are undervalued, okay? So if the CEO does not want to be acquired by a private equity fund, what he or she can do is to try to do the restructuring herself and increase shareholder value before the private equity fund can come and make the offer, right? The other thing we learned in class is that private equity funds have to use leverage to finance deals. These deals are cash financed, okay? So if the company is highly levered to begin with, it's going to be more difficult for private equity funds to do the acquisition. So the other reaction that the CFO or the CEO can consider is to increase the leverage of the company to make it more difficult for the private equity fund to make the acquisition, okay? Let's move on to the beta case. Okay, so this was a simple qualitative case where what you're asked to do is to figure out the beta for Yahoo. Okay, and here the tweak is that Yahoo's business, is just a small part of Yahoo. Okay, which seems like a weird statement until you look at the numbers. Most of the equity value of Yahoo is actually driven by Alibaba. Okay. $30 billion out of the 35 corresponds to the value of the stake in Alibaba, okay? So whatever the beta is, right, if you get the beta from Capital IQ, or if you take stock prices and compute a beta, what you're going to get is an Alibaba beta. This is very similar to the tobacco and wine beta example that we discussed in class, right? Here, Yahoo's beta really is an Alibaba beta, so if you want to estimate Yahoo beta, you're going to need to use other methods, right? So we talked about a couple methods in a class. You could try to use an industry or to look at comparables. For example, you could try to get betas for eBay, American Online, Google, other companies that have similar business as Yahoo, okay? The other thing you could try to do is to use a formula. We didn't talk about this in the lecture notes, but it's good to talk about it now. It actually turns out to be the case that betas average. Okay, so the beta of 1.11 for the company as a whole can be thought of as an average between the Alibaba beta and the Yahoo beta, okay, where you have the market values as weights, Okay, so Alibaba is worth 30 of the 35, the equity stake in Alibaba, right? So all you would have to do is to use this formula. The problem is that Alibaba went public very recently, so it's not going to be easy for you to come up with a good beta estimate for Alibaba. So in this case, you might end up having to use a comparable method. That would have been an appropriate answer to this question. Okay? Finally, on question 5, I gave you data to allow you to estimate the calculation of, to practice the calculation of weighted average cost of capital using Coca-Cola instead of PepsiCo. Okay? The interesting thing here is that the numbers look exactly the same, right? So if you did this right, you should have obtained exactly the same numbers that we obtained for PepsiCo in class. Even the capital structure is the same, okay? So it seems that Coca-Cola and PepsiCo have very similar cost of capital. Does that make sense? Okay? If you think about it, yes, right? These companies are in fact very similar. They are both very large multinational companies that are in the same business, right? They have beverage, they have other food products, okay? So, their WACCs should actually be similar, right? If we had found a very large difference, then it would be, a bit puzzling, and we would actually have to think about why is PepsiCo so much riskier than Coca-Cola, why is Coca-Cola so much riskier than PepsiCo? So I think the answer here actually makes a lot of sense, okay? And then we could use the WACC to estimate economic value added. If using the data that I gave for you in the case, you should have obtained these numbers, okay? The EVA for Coca-Cola in 2014 should have been 4.5 billion. And again, the numbers come out to be very similar to PepsiCo, okay? So Coca-Cola would have been 4.5 billion, PepsiCo would have been 4.6 billion, okay? This is what we did in module 4 in the lecture notes, okay? You can go back there to check, right? So WACC is very similar, EVA is very similar, right? What does that mean, okay? It simply means that these companies are very similar to each other, right? They are both profitable companies that are generating economic value added. They have the same cost of capital, right? So it's really very difficult to distinguish between Coca-Cola and PepsiCo just based on these numbers that we calculated.